Next, we'll look at what happens after the issuance. So one of the beauties of a bond is that it is a marketable security. We mentioned that in chapter 1 when we looked at the definition of security and the definition of marketable, and the bond is a perfect example. It's a security because it's a piece of paper that lays out the rights of the person holding that or owning that particular asset. It's marketable because it's registered with the SEC and floated into the capital markets with the help of the investment banker. So let's look at what happens after the first day. So now Halt Widget is here kind of on the sidelines because what they're doing is they're watching. Now they're watching because it has nothing to do with their requirements, because they know what they have to do. They have to pay $8 million a year for 5 years and then pay 100 at the end of 5. However, when they watch the market, they see a few things. First, they see the impression that companies have on their company. So over time, as the risk of halt reduces, the required return from the bond investors will go down because it's seen as a lower risk. Conversely, if Halt Widget Company's credit gets worse, then the market is not going to like the credit as much because it's riskier and will demand a higher rate of interest. So Halt Widget, although watching doesn't really have any impact on their specific bond, it does give them a view into the marketplace on how the investing public views them as a credit risk. The investment banker over here is also watching, but they're watching for a different reason. They're watching because they may be involved in transactions along the way where one holder of the bond sells to another person who wants the bond. So they're in the transactions, buying and selling bonds during the period. Now, this has nothing to do with Halt Widget Company because that piece of paper is going to have the rights. It has the rights as prescribed. That's why the bond provisions are so important. However, one bondholder may have bought it at, say, 9%. And let's say that the risk of the bond drops for Halt Widget. So the price of the bond will go up because a subsequent buyer, let's say this person, is willing to pay more than 96.11 million for that bond. So the first person say, fine, I'll cash in. So they'll sell the bond and make that spread between their cost, 96.11, and whatever price the new buyer is willing to pay. So this happens every day during the life of the bond. And that's why the markets are so important. It creates this ready liquid source to buy and sell these bonds. So that's the marketplace. And the next step is a possibility, it's not required, where the Halt issuer, Halt Widget Company here, watches and now they have some extra money. So let's say that they had a good year or they had a big stock issuance, but they have excess cash. They might say, I want to buy back some of my bonds. And they have extra money and the pricing of the bond seems attractive. So they, in the secondary markets, let's just call it that, can go in like anybody else can go in and buy bonds. The difference is they're the issuer. So when they buy back their own bonds, they essentially retire it because they don't have to pay anybody now because they bought it back. Nobody has that claim. So therefore, that obligation disappears. So when we retire a bond, there could be a gain or loss on that retirement. And that happens because the book value, which is based on the issuance of the bond in the first place, is then compared to the market when we did the repurchase. If the book value is greater than the market, we made some money, right? We paid less money than what we owe on the books. That leads to a gain on retirement of bonds. The flip side is also true. If the book value is less than the market value, then now we're paying more money than what's on our books. So we're paying more money to get rid of an obligation. That is a loss on retirement. And again, the motivation isn't to be a trader in your own bonds. The motivation is really based on the pricing of the bond relative to your cash position and when you're comfortable getting rid of some financing, because you're essentially accelerating your maturity date of a loan. So you'd only do so willingly if it's comfortable for you. So notice again that the company has nothing to do with the price. The company may have its goals and its preferences, but the market sets the price. So they are a price taker, and based on that price, they want to buy it back. They may certainly do so and just buy it on the marketplace. So the last step is step 5. It's where the company now pays off the bond. You recall that I keep emphasizing that the contract, a bond is simply a contract with terms. Well, the big term is at the scheduled maturity date, HALT now is the main player here, has to take out of its cash enough money to pay back every single one of those owning the bonds and get rid of all claims for the bond. So at this point, we do a payoff, and the life of that bond is over. So that's kind of the lifespan of a bond and the role and involvement of the issuer, in this case, the Halt Widget Company, in that bond.